everyone. Welcome back as always. Thank you for listening, and this time watching. We have another Hot Topics edition where today I'm joined by my friend Kevin Thompson. Hey, Kevin.
Andy, thank you for having me, man. This is fun. I love what you're doing as always. And again, let's just make this a blast. This is going to be a blast of an episode because you always bring the heat.
That's all I do. Lots of heat. So Kevin is the founder and owner of 9i Capital based out of Fort Worth, Texas. And Kevin and I know each other relatively well. We met online through LinkedIn, not some weird way, but through LinkedIn. And he was gracious enough to invite me on a panel that he was hosting earlier in the year at this festival called Future Proof Festival, where we talked about what it's like to own and run and try to build and grow and challenges around small advisory firms. So,
absolutely.
Kevin's a sharp guy. He's in the retirement space as well, and I thought it would be a fun person to have on to rap about some hot topics.
Yeah, man. Again, I love what you're doing. You bring a lot of insight. I'm glad that we finally met in person. That was awesome. I mean, you're the beauty about you is that you're the same person online than you are in person, and that's genuine to me. I like that.
Thank you. Some people don't like that, but no, because they don't like who I am online, so therefore they don't like who I am in person. But no, I think that's important to be your true, authentic self, not just as like a marketing pitch or whatever. But I truly feel, whether in business or personal life or whatever, just be the real you. Don't be ashamed of it and own it. Don't be a jerk either, but be authentic. So,
100%.
Anyway, so this is a Hot Topics episode where we're just going to kind of kick around our thoughts and views and opinions on a handful of things that are either current events or comments or questions or concerns that seem to be consistently on the minds of people in or near retirement. Mm-hmm. And so if you have anything else you want to add in here, Kevin, feel free, and I will as well. But we did, for those listening and watching, we did bat around a few topics initially. So let's start with one that's kind of timely. Mm-hmm. Get your thoughts on this, Kevin. So the One Big Beautiful Bill Act, which was passed July 4th of this year, kind of threw a wrench into some 2025 tax planning for retirees, specifically with things like there's that $6,000 extra bonus deduction per person 65 or older. What are your thoughts on this? I know you have some pretty good views on this. I saw you say on LinkedIn, like, there's income phase out limits around this. Meaning if your income's too high, you don't get any of this $6,000 bonus deduction. So should people who would otherwise going to have their income be high from like Roth conversions or something, dial it back to stay below the income limits to now get some or all of this extra bonus deduction? What do you think?
That's a great question, and I pose it like this because I know you've seen my LinkedIn things. If they're giving you an additional $6,000 or $12,000 if you're married filing jointly over 65 benefit, why not take it? You've already deferred all these dollars into IRAs, 401ks, etc. And now they're saying, okay, we're going to give you an additional $6,000 to $12,000 off of that, off of the dollars that you currently have that are going to be taxed in the future. Perfect. Now just stay within the 150 to 250 or whatever the line is there. The line's there, but to me it's a free conversion. I mean, and I mean free as in a portion of it is coming off of your taxable income, right? So it's like, why not take this? Like, it's just, you're going to get taxed on it anyway in the future. Why not have a portion of it not be taxed? You've already taken the tax deferral. Now they're giving you a little bit back in tax-free distribution in regards to the into the deduction. Why not do that? I mean, that's just my opinion.
Yeah, I struggle with this one. For people, I think the answer is it depends, as is most things.
Don't cop out. Don't be a cop out,
it depends. But scenario: someone has $3-4 million of pre-tax money. You got to come back to the considerations of, if you're married, for example, and one of you predeceases the other, then you have the condensed collapsed tax rates for their survivors. So do you want to get ahead of that tax now? Yeah. And any other reason someone wants to convert, maybe they have like super strong opinions about the future of taxes and things are going to skyrocket. So I sort of view this additional $6,000 bonus, and it's only temporary. It's only a few years that it's around, as almost like a dangling carrot for someone who's, in my opinion, someone whose plan already led to the decision that they should be doing fat, chunky conversions to fill up the 24% bracket or something. Don't let this stop you and rein it back. But if you were already flirting in or around the income phase out range for this, yeah, maybe then you cut back your distributions or your conversions by, 50 grand to get yourself this additional deduction. So I have to give the cop-out answer of it depends. But
Well, I mean, so again, it depends. But my thing is, like you said, if you're already doing it, why not? And if you're already below it, of course. Like if you're below the phase outs, of course, right? But if you're in that phase out range, they're still giving you a percentage off. It's not like it's going to go to zero unless it's going to go over that amount. But you may get phased out a little bit, but you're still taking a little bit of that money off. You're going to save a little bit in taxes. So in my humble opinion, if you're in there, do it, and then it's going to go away, then so be it. But you're saving a little bit on the taxes because you've already deferred it in a quote unquote higher tax environment. So I don't know. We'll see, man. I just think it's an opportunity for sure.
it is. It definitely is, and it complicates it for folks like us who do tax planning for clients. It's completely not upended, but analysis and projections we did January, February this year now changed to some extent as a result of this, if nothing else, for people who are 65 or older. Other sort of little changes in here that may or may not have a big impact to people and whatever their plans or projections were for this year. But one thing I don't like, just because it's going to make my job more difficult from a tax preparation standpoint, in addition to tax planning, but like the itemized deductions coming back for a lot of people with the higher state and local tax cap from 10 grand to now up to 40 grand, income permitting. Which I guess is a good thing all said and done, right? But you have any views about this other than it's definitely going to complicate the tax planning process for folks?
Well, not necessarily in the itemized space, but I feel for these student loan kids, man. Like, and I know this is the most confusing thing that I can imagine. When you have SAVE, you have ICR, you have the pay plans, you have all this stuff, and then they're going to replace it with the RAP plan and the other IBRs and all these acronyms. And then the O3, and I call it the O3B. That's the best thing. I call it the O3BA, right, to make it simple.
I like that.
The O3B. So they complicated this so much right now that these kids either like, oh my God, okay, so I'm in this plan, and now in August they're starting to add in the interest again. What does that mean? Well, I'm still on deferment, but what does that mean? You know what I mean? So now these kids are just getting hit with this interest payments, and they're not necessarily paying it back. So when they start paying it back, they're just paying nothing but interest, and they're seeing their balances every single day go higher and higher and higher. I feel for these kids, and I feel what the O3B did to these kids. That's just my opinion in regards to the other parts of the O3B and what I see this how it's impacting these student loans and stuff. These kids, man, it's not good. In my opinion, it's not good.
I have to admit, I honestly don't know much about the student loan aspects. I remember seeing a headline, something along those lines, about the OBBBA or One Big Beautiful Bill Act, whatever we choose to call it. For better or worse, that doesn't really come up in my practice, just by nature of folks I deal with basically purely in retirement. Not to say some of them
to be fair, like
kids, but
just to be fair, like it doesn't come up to my practice. I don't do a lot with student loans, but I'm asked about it so much that I'm like, oh my God, like I'm always writing articles and stuff. The articles are coming out, and they're asking me about this stuff, so I had to learn about it. Like, oh, that's interesting. And there's so many acronyms. I'm like, man, I don't know why you would even put yourself in this situation at this point. I'd be like, I'm done with it. That's just me, man. This is crazy.
Now, while we're on the topic, this wasn't on our list here, but what you thought about the Trump accounts? Talking about like unnecessary complication.
So I don't understand the difference. I mean, okay, so you're getting some money. That's great, right? But I don't understand like the difference between a 529, a difference between all the other different accounts that are out there for kids. Like, I don't understand like what's the difference outside of you're getting a government dollar, which again, when we talk about this, and we're going to go into it, where's that money coming from, right? I mean, I thought we were supposed to be cutting spending, but now we're just adding more spending to that's an aside, but I don't understand, like what's the difference and why the difference? And maybe you can tell me something I don't know.
What little I think I know about the Trump account thing is it started out with expectations of being much more valuable, flexible, useful, but ultimately got watered down. I think they had to start making some concessions, like, hey, we can't be giving away so much in this bill, so they had to rein some things in. Yeah. So the Trump accounts ultimately, in a super high level nutshell, it's an account that can get funded up until a kid's 18. No redemptions are allowed, like period, full stop, until the kid's 18. There's some government money, I think up to what, $1,000 the government's going to contribute to every
It's a
kid born
one-time
between-
payment. It's a one-time payment. Yeah.
But then parents can put in, I think employers can put in on behalf of the underlying, the kid, the recipient. Once they're 18, this is effectively just an IRA. I think it just sits, you can take the money out at some point, there's deferred taxation on the gains and stuff like that. So it's not nearly as good or impressive or as valuable as it was originally intended, where there's a lot more bells and whistles to it. But if you can get free money, and I forget the specifics around who qualifies, but I think it's like kids born between like now and whatever, 2020 something or other.
Yeah.
The government's going to put in like $1,000 per child to fund this thing. If you can get free money, like take it. $1,000 is $1,000. Outside of that, it's like I don't really see a lot of use case for this.
Well, free money and having a child, that's two polar opposites, right? Because you have a child, that's a negative annuity from day one.
Yeah. If you're going to have a child,
yeah, if you're going,
that's already decided, and you can, on top of that, you can get something for it. Then great, why not? But
yeah, I agree. I just don't understand, like, and then it comes into like my son's special needs. So how is that impacted? You put $1,000 in his account, and then it grows to a certain amount. What does that do to his benefits moving forward?
Right. Yeah.
So it's just it gets convoluted. Like it's just there hasn't been enough. I don't think there's been enough due diligence, quite frankly, that was done in respect to this, versus just it being like a political talking point. Like, hey, let's give money back to the people, because now it's like, give them cake, man. Give them cake. That's all I'm going to say.
I think it was that. I think it was largely, in my opinion, it was a political talking point, some brownie points, and an account that Trump could get his name on that's going to last beyond him. Now you have these Trump accounts floating around for decades, so his name's always going to be attached to them for,
I just but it's taxpayer dollars funding back into a system. Like I just don't understand it. Like we claim to be reducing the deficit, but we're just increasing the. Anyways.
Yep.
That's a whole nother podcast, my friend.
Grow your way out of it. That's it. Just grow your way out of it, right? That's the answer. All right. This next one, curious to see where you go with this. And I'm not expecting anything in particular, because we typically don't get into these things, you and I, much.
I do. But I do. I get into these things a lot.
All right, get into it. What's up with the markets? I'll leave it there. I want to see what your response is to a comment like that. But
the Fed, you can't fight the Fed. The market's going to go up. Why? Because the Fed's going to want to lower interest rates, even though it may be a hawkish tilt coming up. So yeah, they want to lower interest rates. They want to make capital more available to companies, lower borrowing costs. What is that going to do? It's going to increase people's market expectations. Why? Because the risk-free rate goes down, market expectations move higher. Hey, bang, bada boom, market's going to move higher. It's just more, it's more alcohol at the party. You know what I mean?
Yeah.
They're putting more alcohol in the punch bowl. The issue is what happens to inflation, right? So I watched the 10-year yield a lot, and I know it went up like 10 basis points like a week or so ago. The bond vigilantes are going to come in. They're going to start saying something. They're going to wake up, and they're going to say, you know what, we're going to push that yield about 4.5. I'd like to see that, because they can slow a lot of this government spending down. But you and I both know they just want to have higher markets, because it's the wealth effect. People will continue to spend money if they see that they have wealth in markets across the globe. That's just my opinion.
Yeah, it's an interesting mix with the Fed. I don't envy anyone who's in the Federal Reserve and has to make decisions about monetary policy and interest rate policy. Especially the Fed, in theory, is supposed to be independent of political parties. It's there. It has a dual mandate to try to keep inflation at a reasonable range and to try to keep employment, maximized. Clearly, current administration, there's been a push to try to, in effect, bully the Federal Reserve to lower interest rates for the sake of spurring the economy and keep the party going.
Well, let's be fair, Andy. Be fair on that, because every president over time has done the exact same thing. Let's just be fair. I want to be fair on that one.
Yes, I'm sorry, correct. All presidents, to my knowledge, have tried to influence some level of, or exert some level of influence on the Fed.
Yeah. Correct. No, I don't want people jumping, because there's some people out there that are coming to this podcast like, what the hell is this guy doing?
But I don't think anyone's gone as far as saying, I'm going to fire the head of the Fed, because that just simply, that isn't allowed. Like, the presidents don't have that power. But so that's what I mean by I got you. Bully. But you're right. Every president has tried to influence the Fed to some extent. But so lowering rates. The upside is dollar becomes cheaper. People can borrow more, go buy more, spend more. Businesses can borrow more. Stock market goes up, et cetera, et cetera. But The downside is there's likely to be inflation if you cut rates too much. And so the Fed has this hard balancing act it has to do, keep interest rates at a level that don't stifle economic growth too much, but aren't so low that it spurs inflation, and we don't get back to like 8 or 9% inflation like we had in 2022. So I'm curious to see where it goes, like the balancing act of, I think the Fed's going to kind of wait and see little minor tweaks here and there with interest rates going forward and see what happens. But you're right, like bond vigilantes, this is a little technical, but Federal Reserve can only change the overnight borrowing rate that banks borrow and lend to one another. The 10-year Treasury yield is what drives a lot of the market level of interest rates, and that's indirectly influenced by the Federal Reserve and what they do, but more so like the bond market itself, the market's consensus view of things. And so bond vigilantes, they may take it upon themselves to try to like slow down inflation by, you know, changing the rates that are required on Treasury bonds and stuff, but beyond the scope of this.
But can I add something real quick?
Yeah, please.
So you mentioned grow your way out of it. Grow your way out of it. C plus I plus G, X minus M. That's that, you know, the formula. And so how are we growing our way out of it right now? CapEx, AI spend, AI infrastructure. Tons of money going there. That's investment. That's the C. That's the I in the C, right? The CIG or whatever. That's the I. It's the investment. So that's where they're getting the quote unquote increase in GDP right now, because if you have a slowing of the C in the formula, C plus I plus G, you know, if you have a slowing of the C, which is consumption, you have to have it increase somewhere else to increase GDP. And that's where they're getting it right now in the investment. So, but again, how long can that support GDP overall, especially when you have 67 to 70% consumption? We don't know. Only time will tell.
And for those, what Kevin's mentioning, I vaguely recall this from macroeconomics. This formula he's talking about is like GDP is equal to, what is it? Corporate spending plus individual spending,
government spending,
and then minus like deficits, right?
X minus M,
right. So when I'm
sorry, I didn't mean to get too technical. That's my
I like it. I think there's a lot of nerds out there that like to hear that. They, you know, if they haven't been familiar with that formula before, it may be of interest to them now. But I was, you know, largely being sarcastic when I said just grow your way out of it. Right? It doesn't matter what your deficit is. You're just gonna grow, and that's true. You can growing. The economy is one side of the equation. If you can grow the economy, you can get yourself out of sticky situations or inflated stock markets or what have you. But you can't rely on that solely. You can just, we're going to grow it out eventually, right? So maybe you will, maybe you won't. Are you concerned about the stock market?
I'm very concerned about the stock market because the stock market and the regular economy are on divergent paths. I mean, you can't go to a grocery store right now without spending $150 just walking into the grocery store. So to say that it's a hoax and it doesn't exist and all of this inflation doesn't, it's fugazi is incredible to me. I think it's disingenuous on our politicians' behalf to say these types of things. But I think that there has to be some kind of reckoning in regards to, okay, the economy has finally caught up to the stock market. Now what happens? It always happens that way traditionally, right? So eventually it's going to happen. I don't know when and where and how bad it's going to be, but eventually it has to happen because you can't have 50% of the people out there, or was it 38% own nothing in the stock market? So you can't have this amount of people not owning or coming up with everybody else when only the small 10 or 20% that are doing all of the heavy lifting. It's going to eventually break.
I saw an article. I didn't read it. I started to it and then I got distracted. Someone on LinkedIn posted it. I think it was an article from Bloomberg saying just how bad the middle class has gotten and lower class has got. Wow, what was it? Oh, it was like the federal poverty level. It's so jokingly off. Like the federal poverty level for a family of two is like $20,000 or something.
Yeah, it's ridiculous.
That has not kept pace with like actual inflation people have been experiencing over the last 20, 30, 40 years. And it's more like, you know, a family of four in a reasonable priced area on one of the coasts or whatever. It's like $100,000 or something is the federal poverty level in reality. It doesn't show that, you know, in the goofy little economics they use.
Can you imagine a person making $20 an hour today, 40 hours a week? That's like $50,000, something like that, or 55,000, whatever. I don't know the number, but $50,000, single individual. Where are you living? I mean, when you have rent, or your rent's probably what, $1,500 to $2,000 a month. And then you got, that's half of it, dude. It's like, it's tough. It's like, I just don't, that $20 an hour for us would have been like, oh my God, we're rich. Like we were making what, $7 an hour when we were working. Now it's like, this is crazy to me. So yeah, there's some definite misalignment in regards to the numbers.
Everyone's got their own story of like what things used to cost back in the day, but my first job on the books, I did a bunch of jobs off the books. The first job on the books was I worked at a cashier at a supermarket when I was 16, so this was 1994. I got paid $5.05 an hour, and I was there for a few months, up to $5.25. Man, I was stunting. I was like, man, $5.25, look at me now. Like that, even now, like minimum wage in New Jersey is like $15-16. Like that's still not living wage if that's your sole source of income. Even two people working that, that's hard to get by. But
yeah, it's crazy, man. And they're expecting, and then you have the Ford CEO. Was it the Ford CEO or something like, we don't have enough mechanics. We don't have enough mechanics out here or whatever. And I was like, well, obviously, go raise their salaries. Guarantee you this. If you said, you know what, we don't have enough mechanics, we're going to raise the starting salary for mechanics to $250,000. Mechanics will come out of the woodwork. I'm talking about from the mountaintops and start fixing your cars. But they don't want to take that into consideration when we're talking about you don't have enough mechanics, because the majority of mechanics you're talking about don't want to work for the wages that you're providing them.
Right.
Just, I'm sorry, that's my soapbox.
Yeah, I just, my view on the stock market, and it's always this, never try to time it. There's always going to be reason to be concerned. There's always going to be some shoe that could drop that we don't even know what it is. Something like a pandemic's going to come out of left field or whatever. So I don't pretend to be able to know where it's going to go. I used to when I was younger, and I gave up, realized that's just a fool's game. So what I do with people is, it was awesome at the time, whenever things went right, I chalked it up to my own success and skill. Whenever things went wrong, I chalked it up to reasons outside of my control. It was easy. But now it's like, no, that's... the stock market concerns me in that I don't understand why it's so high. You know, the U.S. I haven't checked recently, is up 15% this year. International's up 30%. And that's on back of like good years the last few years. My view is don't be overexposed. We don't know what the stock market is going to do. Always expect it could drop 20-30%. Eventually rebound, right? So if time's on your side, a portion of your money could be there, not money you need to spend in the next 6 months, 1 year. But don't be overexposed. Don't market time, don't speculate. Have an allocation for your investable assets that you're willing and able to withstand if and when stuff gets dicey. That's the best you can do. Otherwise, no one has any idea when the market's going to turn, when the shoe's going to drop, when it's going to stall out, when it's going to crash, when it's going to keep rallying. So that's sort of my parting words. And that's what I tell the client. So hopefully everyone listening is kind of aligned with that. But I don't know. I'm happy the market's up, but it's also like, man, something's got to give. I don't get it.
It's been 3 years in a row, like 20-something% and 20-something%. And now we got 15-16%. Yeah. But again, stimulus, but even in the face of rising rates, the market was still humming along. But a lot of that was, of course, AI infrastructure, .ai. And again, we talk about this like, oh, .com, it's different now. We said the same thing when it was .com. It was different now. It's different. It's never different. It's always the same. It rhymes. Just be prepared.
So what you're saying, just for people to break this down, I think I know where you're going, but like during the tech bubble in the late 90s when stocks were just going stupid high. And the valuations were off the charts. Like, this is way too expensive, historically speaking. Well, the answer was, well, no, the internet's going to revolutionize commerce and industry, and we can't look at old standard stodgy metrics. Like, the growth is going to be there. These companies are going to do gangbusters going forward. And we all know what happened. Now, the internet did revolutionize a lot of the world and industry, but not to the extent it was anticipated back in the late 90s. And so the bubble popped and what have you. Now you're saying it's sort of the same thing, right? Like a lot of the stock market froth or bubble or high prices attributable to, well, AI is going to completely revolutionize and change things. So while stock prices may be high, like the earnings are going to eventually catch up due to AI. That's what you mean by that?
Yeah, so if you look back, I'm not sure what stock, let's just use Microsoft, for example. I just don't, if you look at some of the tech stocks back at the market peak in like 2000, right? And you look at them back like in 2015, it took them really 15 years to get back to that level of where they were back in 2000. So what does that tell you? Well, we have companies that are $5 trillion right now. Microsoft, like $3 trillion, Apple, $3 trillion. I mean, can you imagine looking back 10 years from now and they're like, oh, NVIDIA is now worth, and again, I'm not saying they are, NVIDIA is now worth 3 trillion or 2 trillion or 5 trillion still. Well, that's what you're buying. You're buying future growth. You're buying all the expectations that it's baked into this company through this nascent technology that's supposed to revolutionize the industry. Guess what? Planes revolutionized the industry. I mean, computers revolutionized the industry. This is not anything more revolutionary than the next market cycle, in my opinion. And you're buying things today that could be the exact same price 10 or 15 years from now. That's just my opinion.
And I did happen to pull up, I looked on Yahoo Finance, Microsoft, sure enough, it looks like its peak in the early 2000s. It took until about 2015
there you go.
for it to get back there, give or take. I'm not zoomed in closely, but.
I know a little bit, right?
you know a little something.
Yeah, but that's what should scare a lot of people. Like, you're like, oh my God, this company, and they were probably saying the same thing about Microsoft. This company is going to go to the moon, and it's like, oh well, 15 years later, it still hasn't left the jetway yet. You know what I mean?
Yeah.
So yeah.
Now, interesting. I'm not saying I disagree with you, but let's assume this is accurate. Let's assume the AI tech bubble. We're at the peak of the bubble. It's going to take a decade for the earnings and the fundamentals of these companies to actually catch up to what their current stock prices are. This is not investing advice. I'm not holding you to it, but what would you do or recommend in light of that?
I would still remain invested because these companies, majority of these companies, are still paying some type of a cash flow, like a dividend. I'm not sure NVIDIA is paying that, but like the Microsofts, the Amazons, but possibly maybe the Apple's probably paying a little small dividend. I would still remain diversified because just the natural order of things. The 40 to 45% of the S&P index may be oversaturated towards that. What's going to end up happening is they're going to all, in my opinion, they're going to come down. It's going to diversify the index, and the index is going to smooth out from a return perspective. But those particular companies may not have much more to gain. So the index could still move higher, but those particular companies within that index could be down. So that's just, I would just remain invested. And my most important thing is have a minimum of for my retirees, I want to have a minimum of 1 year's worth of assets in like a treasury or a fixed income portion where you have access to it immediately.
Completely safe, yeah.
Expenses, yeah.
And I like what you said, S&P, look at the top names now, the top 6 or 7 are like 40% of the index, right?
Yeah.
Look what the makeup was 10 years ago, 20 years, 30 years ago. Like, things will change. Companies cycle in and out. I just had this conversation with someone the other day. Like, remember Sears Roebuck? Like, that was a company to be end all companies like 40 years ago, right? Now it's like, I don't even think they exist. Didn't they go bankrupt a handful of years ago? Or
Hey, Andy, if you want to go to Sears with me, let's go, man. I got my Sears card.
I used to love Sears, I'll tell you.
Sears was nice, yeah. Nobody was ever in there, so it was great.
I used to get clothes there. I got a record there, like I got tools there. It was
they had some really good tools for sure.
Okay, the only other thought or comment I had is this international stock market. I've been saying personally and professionally for 10 years now, don't give up on international stocks. The U.S. has pounced on them for the last 15 years, since the global financial crisis. But like, at some point, the tide's going to turn. The U.S. won't always be the dominant economic force compared to the stocks of the rest of the world. This year, we've seen that play out. Like I said before, international stocks, you look at any sort of total international, it's up like 30% for the year, whereas U.S. is up 15-ish. Now, past performance is no guarantee to future results. This isn't saying international is going to do well going forward, but it's just like, I think we just have to pause, step back, and recognize the rest of the world finally had its day. The rest of the world stock market, I should say, finally had its day this year, which was nice to see after 15 years of comparative drought.
Yeah.
All right. Another sort of investing related thing, I think about this every now and again, your take on private credit and more specifically alternative investments, private investments, and the industry's what seems like is a push to get more mass adoption, to get them into 401k plans, to get people buying private credit, for example. What's your take?
Well, I have been really negative on the private credit, private equity, crypto space, especially in regards to the IRAs, qualified assets, things like that. One thing I do know is, and I don't want people jumping down my throat, because I have a friend, close friend, that talks about, he's in the private equity space, and he talks to me about it all the time. They're looking for, so they have redemptions. They have to pay out new investors, so they open up a different fund. So they're looking for different ways to open up new funds to grab investors to pay out old investors. That sounds eerily similar to something else. I'm not saying what it is, but that's what they're doing. They're redeeming to gather assets and things like that in the private equity space. Private credit are loans, right? They're loans. Corporations looking for money. You're giving them money. You're getting a higher yield on those assets. It's supposed to be less risky than regards to private equity, but of course, one's equity, one's credit. So yes, in that sense, it's less risky, but you're taking on additional risk because, of course, the company can default, et cetera, et cetera, et cetera. But private credit, again, you're supposed to get a higher level of income, roughly double digits in a quote-unquote safer environment that's not necessarily tied to necessarily interest rates or anything like that. So from a private credit space, I understand it a little bit more now, especially since I just got back from an event. But I will also say that every manager said this, is getting too frothy. There's too much, all the assets are going one direction, and that's becoming a problem. And a lot of the private credit, and a lot of that stuff is being, and I asked him about that, I said, what is it funding? Is it funding just data centers and things like that? People with bond issuances? Are we just like in another circle, like, where everybody's just funding each other? And he said, yeah, some of it's going to this, some of it's going to that. And I said, well, if everything's going to the same direction, what happens when one of the dominoes fall? You get what I'm saying? Like, especially data centers or AI or whatever, that could be a problem. So that's what scares me about private credit. Like, I think that it's all rushed to the same direction, and I think it's getting very similar to the equity space because it's all headed in that same environment, in my opinion. But again, it's definitely something that could be an alternative to your portfolio if you understand it. But most advisors do not know what they own.
Yes.
and they want to sell it. They want to sell the stuff, but they just, and you don't want to look like that person that when you sell something and next thing you know, like, oh, it didn't work out, having to explain that because you didn't understand what you were buying. This is my opinion.
I think it sounds glamorous, it sounds flashy, it sounds like you know what you're doing when you present to a client some latest and greatest, it does this, it invests in that, it, higher expected returns for a given level of risk, et cetera, but I think the vast majority of advisors don't fully understand or appreciate alternatives and illiquidity around it and what these things are actually invested in, or the fact that many of these private investments, the underlying valuation of the securities is kind of like discretionary by the manager, mark to model. They come up with their own values for this stuff because it's so illiquid. There isn't readily observable market prices for things.
Yeah, you want your value every month, 3 months, 6 months. We'll figure that one out.
Exactly. Like a private investment that invests in a commercial or industrial office space. Yeah. How is it coming up with a monthly valuation? Like it's not, right? This stuff. You only value this whenever you sell a building, or maybe once a year you get a formal appraisal or something. But so they just kind of smooth out the valuations that come up with asset values that are back into some objective they're trying to hit or whatever. I don't know.
I agree.
So I haven't been too involved or on top of the private space. I used to prior to starting my firm in 2019. My career prior to this was providing financing to hedge funds and private equity funds. So I was like very on top of private credit, private equity space. Now, not so much, but I think the vast majority of people, private investments in general aren't something they should really bother getting involved in. Not to say they can't potentially end up producing better returns than their publicly traded counterparts, but is it worth the illiquidity? Is it worth the unknowns? Is it worth the, again, potential subjective pricing on behalf of the fund managers who make this stuff? I don't know. I'm also concerned that if the industry does keep pushing this, like you said, it's frothy. There's going to be so much money chasing these deals. There's not going to be enough good deals out there. The cream of the crop's going to be left for the big players, the big institutions, the pension funds, the endowments, or whatever, that buy this stuff by the billions. The scraps are going to be left to the John and Jane investor who have $50,000 here and there in their IRA. They're going to get these lesser quality deals. Yeah. Such is my speculation about how this is all going to play out, but I could be wrong.
So a couple years ago, what was that? And I was really big into it as well. Kamat Palatpatia, where they were getting the market. They were doing these IPOs. What was it called that it blew up on everybody's face? I can't think of the name of it right now. Anyways, was it scrap? Anyways, I don't know.
Fund?
But no, it was they were these things that you could hold for like a certain amount of time, and you get back.
Oh, SPACs, special purpose act. Yeah, that completely. Yeah, right.
Yeah, this is basically like it's just a SPAC to me. It's like the new greatest, quickest thing. Like, oh, this is sexy. Is it good for high income individuals to possibly put some money somewhere else to get a bit of a higher return? Possibly. I just think from an advisor perspective, you can keep it very simple a majority of the time.
Yeah.
But if you want to add in a little bit of a flavor, like just to be that guy, 100% do it. I mean, but you got to understand what you're doing. If you don't, this market, you have to go in to see what kind of manager it is, because this is about managers. It's not about an index. It's about the manager. If the manager's doing well, does the manager know where they're putting their money, why they're putting their money there? You got to be very manager specific if you're going to go in this environment.
I just want to share some thoughts about SPACs, because I think looking back in hindsight, it's like, of course we knew this was going to happen. So SPAC is Special Purpose Acquisition Company, SPAC.
Yeah.
And it was all the rage. It started, I don't know.
I mean, it's always been around.
It's always been around, but it really picked up steam 5, 6, 7 years ago.
Yeah.
It's basically a company. It's a publicly traded company that's just a blank check company. It's a pot of cash, and that's it. So when investors buy it, all they're buying is just a company that's nothing more than cash. That company says, we plan on acquiring some other company at some point. It may or may not be in so-and-so industry, whatever. So you're just buying into the management team behind this pot of cash, giving them the trust and faith that they're going to buy a company that's worth buying. And then at that point, you in effect own shares of that company that they bought.
Yes.
The benefit and why people would do that is because when a company wants to take its shares public through initial public offering, there's a lot of regulation and SEC dog and pony show companies have to jump through.
Yeah.
It's not when you were this SPAC thing, when you're this blank check pot of cash company, you're already a publicly traded stock who's nothing more than a pot of cash. When you use that pot of cash to buy some other company that was previously private, the sort of SEC and like what's the regulatory process around that is so much less than it is to actually take a company truly private.
1000%.
Looking back, it's like, of course you're going to get these crappy deals where the accounting was fluffy or whatever, because there's so little not oversight, but whatever, diligence that went into this as part of taking it public through this SPAC process. Sure enough, like a lot of stuff, what was it, Fisker? Or the truck company, Nikola.
There was tons.
There's a bunch, right? There's a bunch.
Yeah.
Looking back now, they went public through SPAC process, and they all had like questionable accounting, and they all ended up doing like squat because of it.
Yeah.
So, whatever. You're right. It's like the latest shiny object that the industry pushed out there, and everyone jumped on the bandwagon while the getting was good, especially the managers who were making money from creating these SPACs.
Yeah.
But who was left holding the bag? The investors, where some of these worked out, but a lot of them were just completely fizzled and did not do well. So
1000%, man. That's what concerns me. I just think that it's just the same thing, different lens. Now PE's just trying to go raise cash. I mean, they're needing redemptions. They have investors wanting out. They're wanting to go get new capital. And I'm not saying they're all doing that, but I mean, they're looking for new pots of cash. That's why they're going into qualified accounts. And then of course PC is the same way. They're just looking for other opportunities to grab assets, and more power to them. I mean, it's Wall Street.
That's what they do. It's what they're in the business of doing, right? So
yeah, exactly.
Alrighty, less market talk now about some more kind of things, more tangible and day-to-day to people entering your retirement. IRMAA, income-related monthly adjustment amounts, which most people listening are very familiar with that. If your income's over a certain level, you have to pay more for Medicare, and there's different bands of sort of progressively higher surcharge rates. Some clients I work with, some people I talk to are fundamentally opposed to ever paying any IRMAA, period, even if it could potentially benefit them longer term from doing like Roth conversions or getting ahead of like large pre-tax balances. Other clients completely okay with IRMAA within reason. They don't want to get too high up to IRMAA brackets, but whatever. What's your view? How do you give guidance to people on this?
Yeah. So I recently, I did a show with our boy Paul Morrison, the IRMAA guy. He's a good dude, man. He knows his stuff. And one thing that I've learned, in my experience, what I've learned was, the SSA 44, making sure like when you retire, you make sure you do that, because they'll be like, what's this? You don't want to be 2 years down the road and be like, what the hell just happened? You know what I mean? So it's just like the proper channels on getting things done the correct way, making sure you're not paying IRMAA. Now, I'm assuming a lot of the people listening know what IRMAA is, so we don't have to go through all of that, but the brackets are really large, especially for a lot of my clients who are married filing jointly. So I think it's like 218, 0 to 218. That's the single bracket.
Yeah.
So majority of my clients they make about 150, 175, maybe 180. So they're underneath that. Now I think it's pretty simple ways, especially with the current quote, the deduction that we currently have. The enhanced deduction is going to bring people down as well. So there's ways to minimize that as much as we can. But when you get above that, those brackets, like they condense, man. There's like from 2 this to 2 this, you're gonna be in this bracket, and from 2 this to 3 this.
$50,000 maybe is that first one for married.
And it's like,
people,
whoa, this is crazy. You know what I mean? So yeah, if I was above all of that, yeah, I can understand it. And I have maybe 2 clients that are in that ridiculous world where it's like, okay, let's figure this out. But when you're in this ridiculous world, it's like, what's another $150 a month or $200 a month to I mean, okay, I don't have to worry about it. Yeah, I pay a little bit more, but it's small potatoes to me, even though I know it's costing me more money. But there's ways around it, and we do our best from a tax planning perspective to do so. But at certain levels, it's like there's nothing you really can do.
Right. Well, one of my
maybe you can tell me something that I don't know. I don't know, man. It's like
no, it really depends. But I just think I do know some people who are fundamentally opposed to IRMAA, like full stop. Others completely okay with it in the name of longer term tax planning.
Yeah.
I think one of the best framings of it is someone once said he's a retired doctor. When he had his practice, was paying full sticker price for a policy that was whatever, $2,500 a month for he and his wife, let's say, right? And it wasn't even great coverage.
Yeah.
He retired, has a good amount of money, and is subject to IRMAA, is completely okay with filling up income as much as possible, even to max out IRMAA, like to do conversions and stuff. Because even with the highest level of IRMAA, on top of, so highest level of IRMAA is like $500-600 a month extra per person for a year. That times 12 months is what? That's like $6,000 or $7,000 a year, let's say, on top of your base premiums, which are $200 a month for Part B. So whatever. His point was, like, even with the full IRMAA, I'm still paying substantially less for my health insurance premiums than I was when I was working, and it's substantially better coverage.
Yeah.
So he's like, I'm fine with IRMAA. Like, I don't care at all, because comparatively speaking, it's a good policy for much less than I was paying prior.
Yeah.
So that's. I'm not saying everyone should buy into that, but I was like, you know what? That really, yes. If you're paying an extra $100, $150 a month for Medicare, no one likes spending more than they otherwise have to, but you're still spending $300 a month total premiums.
Yeah, versus paying like what, maybe $800-900, maybe $1,000 a month.
$1,000 if not more. Yeah. So I don't know. It's all on how you frame it and how you choose to look at it. But this is an interesting one to walk with people, because people have such different views and opinions about their tolerance for paying more for Medicare.
A lot of it, I think, has to do with someone's political leanings. Like, I don't want to pay the government anything. I'm not doing anything.
Yeah.
They're taking my money in these bridges and all this. I'm like, hey, man, whatever. But I truly believe, like I said, that point you just made is fascinating to me, because it's like, yeah, you're absolutely paying less than you were when you were working. So,
yeah.
But now that gets to the point about, and I'm not sure if we're going to go here or not, but from a Medicare Advantage perspective, like I'm starting to see so many commercials trying to push people towards Medicare Advantage. It makes me sick, quite frankly.
Let's go there. Why does it make you sick?
Because you and I both know that traditional Medicare with Plan G, I think even though you may pay a little bit more, I think it does everything you need for. I think it's a better benefit. And like I got a friend next door. He's on Medicare Part G and Plan G, and he just boom. It's like I can go anywhere. I can do anything. Yeah, I pay a little extra, but I'm okay. Versus like Medicare Advantage. Okay, I'm getting it for cheap, but I can't go here, I can't do this. And by the way, hey, I went to this doctor a couple days ago, and he was in network, but the hospital I went to was out of network. So guess what? I'm left with a bag of bill. Just get rid of all that crap, man. Like the privatization of all that, just get rid of it, put it back on the government. And I read something today, matter of fact, they're saying if everyone went from Medicare Advantage back to Medicare, the government would save $800 billion, or I think it was either 80 billion or 800 billion. The number's a big difference, but billions of dollars a year they would save by having everybody on Medicare versus paying Medicare Advantage.
Really?
Just saying.
Wow.
Yeah. I'm just saying. Like I read that today because I was writing an article. And like, oh, that's interesting. And they were saying coming from the Social Security, this, that, and the other, the government would save tons of money by having everybody go to Medicare because the subsidies that they're providing these companies is just way too expensive.
Yeah. But every September, October, Joe Namath comes on TV and tells me I should buy a Medicare Advantage plan. You're saying that's not what I should do?
Hey, man, I'm just of the opinion that traditional Medicare, get you a good Medigap plan, call it a day, and don't listen to Joe Namath, because I mean, I know Broadway Joe, but I don't know if his teeth are.
No, his teeth are way too good. Yeah, for folks. So I generally feel the same. Traditional Medicare plus Medigap, when you actually need the coverage, it is going to likely end up being better for you. Medicare Advantage, which is otherwise known as Part C, it's the government unloading the running of the medical care for people to a private insurer. So when you have traditional Medicare, the government pays for it at negotiated rates, whatever. The government basically offloads that with Advantage, and they pay like United Healthcare or Aetna or whoever to administer Advantage. The government pays them, I understand, a flat rate. Like here, you take this person's health care off our hands, we'll pay, I'm making this up, I have no idea what it is. We'll pay you $2,000 per year, Aetna. That's all you get. Like you worry about doing the rest. So of course, Aetna is in profit maximization mode. They're getting a fixed amount from the government to handle your medical needs for you. So of course, they're going to run it like a for-profit business, try to skimp where they can and cut back here where they can, and deny. Initially, hope you go away before they actually pay for claims and stuff like that. Now, to be fair, I know
that's the thing about Medicare, though. But that's the thing about Medicare, because prior authorizations were quote unquote not necessarily a big deal, but with Medicare Advantage, their prior authorizations were, hey, we got to go through all of these steps. But now they're trying to bring prior authorizations back to traditional Medicare.
Okay, interesting.
This is crazy. Go ahead.
Traditional Medicare doesn't matter where you are in the country. If you travel a lot, if you're an RV person, if someone takes Medicare, they take Medicare, period. With Advantage, it's more like traditional commercial healthcare you may have had through employers, where there's going to be networks or provider networks or what have you. I know of people on Advantage, and it's working well for them. So, I can't say no one should ever get it. But I think generally speaking, if you're healthy, if you're a minimal user of health services, then yes, the cost savings of Advantage could work. But when you really need it, that's when I think people find out, ooh, this plan isn't what I thought it was. They get more pushback and less coverage and what have you, versus traditional Medicare. You're generally good to go as long as it's a place that accepts it.
Yeah. So I'm going to say this. So I recently bought me a new truck, and we were talking about it before. And I'm at that point in my life where I don't want any hassle. I'm 46, about to turn, I'm basically 50 years old. I drink Earl Grey tea. I'm that guy, right? And I'm like, whatever I can pay to make my life that much easier, that's what I want to do. And that's what I did. I went in there to go to Tacoma. Hey, what are the options here? Okay, I want this. You got this regular plan, warranty, this plan. Here's the platinum. I said, what does that cover? I got the big tires on my truck. I said, give me that one, because if anything happens, I just want to bring it in and you take care of it. I don't care. I'm at that point in my life. Like, I just want easy. And I think that's from a standpoint of retiree, you should want easy. Versus like, okay, well, I found out that I have a $5,000 bill because the hospital that I went to was out of network, but my doctor was in network. That's a problem.
Yes, that's going to be a lot of hassle to get squared away.
Yeah.
Return on hassle. I forget who coined that, but return on hassle. You got to think about, like, is it worth all this extra stuff you have to do? What's the return on that? In your case, you want it easy, you want it covered, just minimize return on hassle.
Yeah, exactly.
All right. What else we got here? Another thing, this keeps coming up recently with clients, coincidentally. I mean, it's an important topic, but what do you do with help people address or get ahead of mental capacity issues, financial or elder abuse, et cetera? I mean, you don't need to disclose your firm's particular processes, but just what are your thoughts, best practices, anything you want to share with people?
I am a proponent of using wealth.com, getting the estate plan, like the financial power of attorneys, all like durable power of attorneys, medical power of attorneys, POAs, all that stuff in-house, so I can have all of that. And that's one way I do it. Now, has it been a great like, has it worked out well? Not necessarily, because some people do it, some people don't. And one thing I found out is, like, when you start combining things and like, oh, it just comes with it, then people lose the quote unquote the value of what it actually is, because they don't understand that, people charge you $3,000 to $5,000 to get these trust documents and stuff taken care of. And I'm basically adding this in as a value add to our overall financial plan in regards to like the engagement fee that we charge. But it's just like, when you just do that, they don't see the value. So maybe you need to strip it out and say, okay, here's $3,000 to get this done. I guarantee you people will be like, oh, I need to get this stuff done. I need to go ahead and get it done. I don't know why our brains are wired that way, but it is what it is. But I've had a couple of clients, and I remember this distinctly, where I heard the son talking in the background, telling the mother what to say to me. And then she was like, and she whispered to me, she says, "Is this okay?" I said, "No, it's not okay. It's not okay. I'm gonna put a freeze on your account right now. Nothing's happening right now," because he was basically bullying her to say things about her account to get assets from her.
Wow.
And I was like, whoa, yeah, I've had that happen. And I put, so what we'll do is we'll put some notes in the account, like, hey, hard stop, freeze. And then what you can normally do is you can call an agency in their town or in the state, and the agency will say, hey, there's a hotline, this is what's going on, her name is this, and this, and they can basically make sure that all our credit reports and everything is frozen as well. But it's kind of intriguing how all that stuff works, because a lot of it comes from within the family versus just an outside individual, like a Russian hacker or something like that.
Right. Yeah, that's scary when it's someone closest to you, child or whatever. I haven't directly seen that play out yet with folks I work with, but I've heard stories from others in the industry. It's frightening, the stuff people do to their parents or other loved ones.
Yeah. She was frightened because her husband just passed away, and the kid was just being aggressive. I was like, man, this is crazy. So I just had to step in, and he maybe he doesn't like me. I don't care, but it is what it is. I'm protecting her. That's my job.
Do they live nearby? Did you go over there and slap them around a little bit, or no?
No, they live in South Texas. So no, I ain't slapping nobody around. I'm too old.
Texas is a big place. That's like a 8-hour flight away. Texas is huge, man. Yeah.
Man, Texas is huge. It's too big, man. But it's a lot of it's flyover country. You don't want to stop in any of those towns. Trust me.
It's crazy coming from like here, Northeast New Jersey, small, Delaware, small, Rhode Island, small, Connecticut. Like you, in a 5-hour drive, I can get through like 7 different states. Yeah. In Texas, 5 hours, you can get like halfway through the state. But
where you at? I'm still in Fort Worth, man.
Yeah, right. I get there. I'm on the outskirts finally. I might get there. Oh, man.
Yeah, man. Yeah.
All right, this final one, very generic. I want to curious to your thoughts here, but what keeps you up at night as an advisor?
Outside of the Earl Grey tea?
Drinking too much of that late at night, yeah.
Yeah. So for me, my child, my special needs kid, knowing that I haven't done the special needs trust yet, I have a trust set up for myself and my family, but I haven't done the special needs trust where I go in and get the elections done by a proper attorney. The Wealth.com platform doesn't provide that, so I need to go in, have an attorney do it, get the right elections. So if something were to happen to me, all the money that flows directly to the trust, or me and my wife, flows directly to the trust outside of his quote unquote, his domain, to where it doesn't impact his benefits. I haven't done that yet. I know I need to get it done. Cobbler's kids don't have any shoes, right? But I need to get that one done. That's what keeps me up at night.
Do you have any clients with special needs kids where you've gotten on them to get it done and you don't do it yourself?
Yeah, I've gotten them, but that's the thing. Like a couple of my clients that have had special needs kids still haven't gotten theirs done either. I'm like, what's going on? It's like, yeah, we're gonna get it done. We're gonna get it done. And then when things happen, it's always in haste, right? It's always in haste. Like, oh, we gotta get this done. Who could I talk to and I've contacted the attorney I need to contact, and she's kind of, I mean, it's like $4,000 to get just a special needs trust. Like, whoa, this is crazy, but I know I need to get it done. So I'll be getting that done probably Q1 of next year.
Now, how about, I mean, that's good. Thanks for sharing. That's something you need to do, on your own docket. But on behalf of clients and manage money you manage and people you work with, what's sort of the big lurking concern or concerns that if anything keeps you up at night besides Earl Grey tea, that you might eventually lose sleep over on behalf of clients?
Yeah. Well, it's not knowing what I should have known, and the fear of the unknown, I guess. But I guess to put that succinctly, not protecting them enough to, like, Kevin, why didn't you see this coming? Like, it's just like, I know it's not my responsibility, but I don't want them to say, Kevin, we're down 40% or 50%. Why didn't you see this coming? That's what scares me, to be brutally honest. Like, I know I can't do anything about it, but I know I should. And I don't know, I don't even know what that even means, right? But you get what I'm saying? Like, I don't know what it means, but I know it exists in my head. So, yeah, that's where I'm at, man. I know I got a crazy world up there, man. That's just where I live, And maybe it's stuck in the fro somewhere, right?
Or cut back on the Earl Grey. It's mess with your mental clarity, maybe. I don't know.
So what about you? What keeps you up at night?
It's two things. I mean, frankly, I sleep fairly well. Some nights, rarely.
I mean, I sleep well. My wife caught me snoring. She had me taped snoring a couple nights ago. So there you go.
Yeah. You get mouth tape or whatever. Keep your mouth closed so you don't snore less. I don't know. It's really two things. It's the unknowns. Like, I know stock market correction is going to happen. I don't know when, I don't know how big it's going to be, but I know it's going to happen. It's the stuff you don't know that you're taking completely by surprise. Like, again, pandemic. Now, we saw that sort of coming weeks in advance, and then it escalated quickly. But the extent of the stock market drop in those couple of weeks when it, like, really hit, that was bad. There's no way to have seen that coming, or even if you did, what are you going to do about it? You don't know the extent of the drop that's going to happen. We haven't had since, 100 years since there was like a global shutdown from a pandemic type thing. But what are you going to do? Once you're in it, it's like you can't bail at that point. You kind of have to, this was my plan was for, this is why you go back to make sure you're not overexposed to risky stuff. Yeah. So being concerned about what I don't know is like, there's nothing you can do about it anyway. It's going to be a World War III. It's going to be someone launches a nuclear bomb. It's going to be another pandemic. It's going to be God knows what. But that's the stuff sometimes I get agitated over, or whatever, lose sleep over. The other thing, just bigger planning perspective, is like long-term care is such a wild card for people. Yeah. But what really concerns me is not just, I don't want to say the standard because there's no standard, but the 1 to 2 to maybe 3 years of long-term care where you physically decline and then you kind of check out after that. That I'm accounting for people's plans, and that I feel like I have a good handle on an analysis of how's this going to be addressed if you don't have traditional insurance or whatever. It's like the 10-year stays in memory care units. That if that happens, you can't plan for that. The vast majority of people can't fund that. You can't buy insurance to cover you 10 years. Yes. And I don't know how to attempt to address that for people other than saying, like, if this happens, like, this is the plan buster for most people. But what do you do? What do you do in advance of that? Like, you can't practically hedge that. Wow. So that's I don't have any clients that are, at really high risk of that being a potential thing yet, but that's what concerns me. Like, if that happens, you don't have a lot of options.
I had a client that had a 3 to, I think maybe 4 year stint in a memory care. It was, like $7,000 a month, $8,000 a month, like boom, 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 boom. And I was like, geez, man. Fortunately, he had like a couple $1 million, so his kid's got some pretty good lump sums coming out. But he passed away 3 years into, maybe 3 or 4 years into it. But it was one of those things where he was supposed to pass away like in 7, 8 months or 9 months, and he was like year 2, year 3, like, man, this is getting, And one thing I've noticed, like, and I've started thinking about QLACs more, like, I think QLACs will be an awesome opportunity for people those, like, can put it like a lump sum away and get that benefit, 80, 85, whatever that looks like, to offset some of that long-term care expense, I think it's powerful, in my opinion. That's what I mean, because you can't necessarily buy a traditional long-term care policy. It's just either A, too expensive, or B, nobody's going to underwrite them. So that's what I've been doing.
For people wondering why I said memory care in particular, because that means, like, I'm assuming your body is more or less physically fine, so you're not going to physically deteriorate too quickly, but your mind is still there, memory slipping, but, like, you can still live on for a better part of a decade with memory care issues if you don't have physical issues accompanying it. 100%. That's the scenario where, like, that I don't know how you plan for that, but
can't, man. That's powerful. I appreciate you mentioning that.
Yeah. All right. That's all I got. Anything else you wanted to chat about?
No, man. I appreciate the opportunity. This was great. Love what you're doing. Hey, I was going to say that what keeps you up at night is some of these IUL guys. That probably keeps you up at night.
Oh, man, don't get me. Actually, it doesn't. I sleep very well with my stance and my public campaigns about my education on IULs and how they're sold. So,
yeah.
If anything, I sleep better because of that. If I didn't say stuff, I'd be like, oh, I can't believe that guy just got away with saying that. So by me saying something counter to that in public helps me feel like I'm doing a little bit of service here.
Man, you did a great service, man. I've learned a lot from you, man, and I appreciate what you're doing. Seriously. I thank you so much.
Awesome. Thanks for being on. So, Kevin, where can people go to find out more about you and your stuff?
Oh, man, you can go to my website, 9icapitalgroup.com. You can go to our YouTube channel at 9iCap. You can follow us on all social media channels at MLB2CFP or at 9iCAP, 9iCap. And then finally, check out our new Substack, which is Now What, on our Substack station. But of course, YouTube, podcasts, 9Indies Capital Group podcast, all that stuff. Love for you to follow us. Appreciate you guys. Andy, thank you for so much for all the things you're doing, man. And again, man, this has been awesome. I love your energy.
Thank you. Likewise, Kevin. Appreciate you coming on, and thanks for listening, everyone. Take care.